Hey, everybody. Welcome back to the Bitcoin Business Bureau. I'm your host, as always, LitecoinLeader. I got a lot to talk about today. I've been busy, obviously, with, voting and stuff in the last couple of days. But here we are. It's Wednesday. There's not going to be an AMA tonight, but there is going to be an interesting video right now about liquidity. Okay, so liquidity crisis for FTX. It was a huge story. It started, I think it was Monday night, and then it bled into Tuesday. All kinds of stories, up and down story. So what happened was FTX, for whatever reason, lots of people were pulling lots of crypto off the exchange. Okay. And then eventually people started to get wind that FTX may not have all the coins that they claim that they have. So that proved to be true very quickly when they stopped taking or stopped doing withdrawals. You could not withdraw Tuesday morning from FTX. Major problem that basically screams that they don't have the coins that they claim to have. Big surprise. That happens a lot with exchanges because the way an exchange makes money is through volume. They want to trade Bitcoin to Ethereum, Ethereum to Litecoin, Bitcoin to Litecoin, you name it, they want to trade it. And every time you trade, they get a transaction fee. So they want to have as much liquidity in the market so you could trade from A to B, B to C, A to C, all these different transactions, so you can get a little bit of every transaction, and that's how they're supposed to make their money. Well, if they're saying that they have lots of Bitcoin, lots of Ethereum, lots of Litecoin for people to trade between, and they don't, and all of a sudden people start trying to pull all their Bitcoin off the market or all their Ethereum off the market, and it's not there, well, first off, the people that know how to look at the blockchain start to see this. And then word gets out in a very small community like crypto is, and just saying, hey, we're seeing a problem with FTX. They seem to not have as much liquidity as they claim. And then the next morning, well, first the price starts to drop of it's FTT was their coin. Then FTX comes out and says, hey, we're not going to do withdrawals right now because they can't. They don't have the Bitcoin for you to withdraw. They can obviously take the transaction, say it's processing. That doesn't mean they're going to execute it because they don't have the Bitcoin to execute it with. So basically they were just numbers on a screen. So that's the kind of thing that you have to be warned about. And this is why we say, not your keys, not your coins, get your crypto into some form of device. You can use one of these ledgers or treasures. I don't use them. I've talked about in my security video, which is on the front page of LitecoinLeader.com. It's the #1 video I put out there of using one of these guys to use a smartphone, and there are ways to keep this as a good, sound, fundamental wallet. There are other options too, but the point is you got to get your crypto off of an exchange and into your own control so you don't have what's called counterparty risk. That's as if you have, every time you have, this right here has less counterparty risk than $20 in my bank account. Okay. If I go online and look at my bank account and it says, hey, you've got $20, that could be taken away tomorrow through, well, first, a bank could charge me a fee, or they could just shut my account, or the bank could go belly up. All those reasons that $20 could be gone tomorrow, but at least I've got the $20 right here. Now, if people stop accepting these, or this $20 magically starts to appear and buys about what this can buy, that's a different story. But the counterparty risk of having things stored with someone else, that's a major problem. And that's what I want to talk about today, and the issues with some of the other asset classes that people have beyond just crypto. I mean, crypto, people think like, hey, crypto's risky. What if the internet goes down and so on? Sure, I get that. I get that you have those concerns. But if you have crypto under your control, you're in pretty good shape as long as the internet eventually comes back online. Okay, so you've got your funds under your wealth under your control. There's no counterparty risk. So let's go through a few of the other assets and talk about liquidity issues and how there could be runs on them and what that would look like. So let's start with the exchanges. Like, let's just pick another exchange. I don't think it's going to be Binance because Binance is apparently buying FTX. But let's say Coinbase, right? Let's say they don't have enough coins. Let's just say that, people start thinking, I just saw what happened with FTX. Does Coinbase have enough coins? Then if people start pulling coins off of that, then Coinbase shuts down withdrawals. This is a what if. This is not financial advice, and this is just one guy talking on the internet, just telling you his thoughts and sharing what I'm going through and what I've thought about. But I'm just sharing my thoughts with you just so you can think about them for yourself too. So What if Coinbase had the same problem as FTX? Same issues would apply. The first ones there that could get their stuff off would probably get them, and then eventually Coinbase would turn the faucet off, and then Coinbase would be in trouble, and they may have to restructure, whatever. This is very similar to what happened in bank runs in the 1920s in the United States. Okay, when banks and savings and loans had issues in the past, account holders would try to get their funds out of that bank before, and they'd all run there as fast as possible to get there and get their funds out, to avoid that counterparty risk of saying, what if that bank doesn't open its doors tomorrow? So then your money is trapped forever, or maybe even gone. So you run to the bank, you try to get it out, and that is literally a run on the bank. And if there's not enough funds in the bank, then they can't pay off everyone who's asking for their money back. That can happen, and that's happened before, and it could happen again. And that is because of the nature of banking and the fractional banking, and the fact that they loan out way more than they actually have in their reserves and cash on hand. If you're counting on FDIC insurance, the Federal Deposit Insurance, whatever, it's only 1 or 2% funded. And I know there's rules about up to a certain amount, like it's $250,000 in your account. They try to make it sound like it's, oh, you're perfectly safe. The funds that are in that insurance fund to back up the FDIC insurance, it's 1 to 2% of all the accounts that are allegedly FDIC insured. So you're not fully insured. It's false confidence in the system. So banks can have an issue. And of course, I've talked about bail-ins before. I'll post this video up here about bail-ins. I'm talking about it probably tomorrow as I get these videos out in the right order, about what can happen there. But basically, when they restructured banking in 2008, because that almost collapsed, and they had to bail out the big banks. But after that, 2 years later, there was the Dodd-Frank Act, and that forced all the banks that really of certain size that have FDIC insurance to have a restructuring plan in the event that those banks collapse. So as part of that bankruptcy plan, they plan on taking all those funds in your accounts and reallocating those to their creditors that have a higher priority. So basically, they're going to bail in the funds that are, allegedly on the books. So if you have $10,000 in a bank account, they could take that $10,000 and pay off another creditor in the event of a bankruptcy or the bank just going belly up. And your FDIC insurance might give you $100 to $200. So don't think your money is safe in a bank either. So let's go. So we've talked about crypto exchanges. We've talked about banks. Let's talk about stocks for a minute. Now, stocks, if you don't know the term rehypothecation, you should really go and look that up. And what that means is selling stuff you don't own. So this has happened. This is the fractional banking equivalent for the stock market. So imagine you have a share of Tesla. Let's just say you out there, I'm probably someone in my audience owns a share of Tesla. Okay. But how do you own it? Do you own it in an account? Do you have it in like your E-Trade account? Do you actually have the certificate? Odds are you don't, because most of those owned by a company called Seed Incorporated, CEDE. You guys can go down that rabbit hole if you want. But mostly you do not have the stock share that proves ownership in a company. It used to be that you did, but odds are you don't. So now you just have a number in an account. Well, guess what? A lot of other people have that same number in their account too. And no one really knows how many shares of have been rehypothecated and to what extent. But I think it's a reasonable assumption that for every 1 share of Tesla or 1 share of Apple, 1 share of Ford, there's probably at least 50 claims on that share, if not more, which means that in the event of the stock market having an issue, which eventually will happen if the financial system all starts to collapse all at once, there'll be runs on stocks too. And only 1 out of 50, if that, will get their assets back or be made whole in some way, shape, or form. By the time the rest of them are made whole, it's not going to be worth anything. So that's the problem with stocks. So we've gone over exchanges. There's the stock exchange too. You've got the crypto exchange, you've got the stock exchange, you've got banks. What about real estate? Okay. At least, hey, real estate, at least I own the property. I'm there on it. And what are the rights that you have to that property? It's the deed, right? Well, where is that deed recorded? Okay. It's with a county, and probably sometimes the state, but usually with a county that has a record of the property ownership. Now, that sounds great, but we've all encountered, or most of us have. I used to do real estate. I saw this all the time. We know about title companies, right? You do title companies. Those companies are paid to do a title search to confirm ownership. Now, if we had clear ownership of real estate, that really wouldn't be necessary now, would it? But yet they have to go and check and say who owns 123 Main Street. And every time a property transacts, they have to do that. Now, I've encountered several times where the title is clouded or there's questions about the title because there's not clear paperwork on it. Now, if things had been kept on a blockchain that was a public record and it was immutable, you couldn't change it, right? Then there wouldn't be those problems. But in the real estate market, this does happen. It's less of a problem, certainly, than the stock market or the exchanges and those rehypothecation issues. But deed paperwork is not perfect. And of course, then you have taxation by the governments. That's another issue. But as far as ownership, liquidity, real estate is probably as far as ownership, it's easiest to prove. But liquidity of real estate is tough because it's tough to get. Once you buy a property, it's tough. You can't dig up a piece of ground and go to exchange that for food or other supplies that you need. So liquefying that asset can be difficult because that's what the banking system is supposed to do. So if you can't get a loan against the property, you can't sell a piece of your equity or piece of your land easily because you're not allowed to subdivide it. You're not allowed to give like a fractional share of your land. That's an issue too. But for the most part, real estate looks pretty good, but there are better ways of record keeping. Going back now to other assets you can have. There's this, right? There's gold and silver, okay? So gold and silver, having the physical metal is way different than having a stock in a company that does exploration or even ownership on paper for silver and gold. I think I heard from Lynette Zhang that the claims on gold, for every 1 ounce of gold, there's 62,000 contracts for that same ounce of gold. So when you want to talk about rehypothecation, silver and gold precious metals is one of the worst as far as paperwork, and that's why it's such a manipulated asset class. Silver and gold prices are not reflective of the actual value. Just look at the premiums on silver these days. It's almost double of what the actual spot price is. So if the spot price is roughly $20 for silver, try and get an American Eagle for less than $40 or thereabouts. Not easy. So why would 1 ounce of silver in the form of an American Eagle be twice as much as the paper price? It's because of this discrepancy between the physical market of something you can tangibly hold and have no counterparty risk. You have no third party that's involved. You own the coin. Like, I've got this coin right here and it's in my hand, right? There's no counterparty risk there. But if you own a paper contract that says I own the rights to an ounce, there's lots of risk to it because of what I said earlier, 62,000 claims that same ounce. So that's the issues with liquidity in different markets. Now, of course, blockchain is the answer to this, right? And that's why a lot of the crypto people scream up and down that crypto is the right answer. But the real answer is blockchain, and crypto is just one form of that. A blockchain is a digital record of chronological or sequential information. And it's immutable, it's decentralized. Those are the best ones. You can have a centralized blockchain, but then you have a central point of risk. You can, if you don't have an immutable blockchain that people can change it, that's not good either. So you could change like who owns 123 Main Street, make a change, and now you've got a problem of who owns that property. But if you have a blockchain that's immutable, you can't change it. It's decentralized, and it's all over the globe, and no one person can make a change. Everybody's got to approve it. So now you've got a good digital record that's sequential, it's chronological, it's written block after block after block that are all linked together. You have a history and a sequential history of all the assets that are on that blockchain or all the information on the blockchain. That information is recorded and it's not going to change. So ownership of things is very easy to prove. So that works for cryptocurrency, works for real estate, works for a stock in a company. It works for precious metal ownership of real estate. All that stuff on a blockchain is really the answer. But we're going to have liquidity issues like what's going on with FTX. We've had it with other cryptocurrencies, but it's not only going to happen in the crypto market. It's going to happen eventually when things are discovered about these things that I'd mentioned earlier are discovered about these other markets. So that's when it's really going to hit the fan and it's going to get crazy. So reduce counterparty risk, have tangible assets under your control, have physical gold or silver, diversify your risk, diversify your assets, but get rid of counterparty risk as much as possible. Have your assets under control. Have a little bit of cash on hand. Have some precious metals. Have some cryptocurrency in some way, shape, or form that you have under your control, so that no one else can grab it from you. And that way, you've got it all under wraps, and you've got no counterparty risk. You're not worried about these liquidity issues, but you're prepared and not scared when these things eventually do happen. So, lots said today. I can't wait to read your feedback and your comments about this, because I know it's a big story with FTX right now, and it's going to continue, and it's going to get crazier when it gets out of the crypto market and really everybody starts talking about it. So looking forward to your comments, but I'm going to stop there. I'm going to say, with all that said, I'm going to close the drawer in the bureau, say follow leader one more time, and I will talk to you soon. Take care.